Saturday, October 28th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we've got Clive Thompson on. It's been almost a year since we first spoke. That video, of course, went viral. And today, Clive wants to talk a little bit about pensions, savings, and also clarify a lot of the terminology that we use, because many people don't know sometimes if we just say CBDC, what it really means. So Clive thought it would be good to clarify a lot of things and talk about his own experience with his pension and savings. Clive, welcome to the channel again. How are you?
Hi, Mario. I'm very well, thank you. It's a bit of a cloudy day here in Switzerland, but it's going to be a nice day, I think. We've had a lot of rain in the last few weeks.
Yeah, the same here. I guess summer is definitely finished. Beginning of October was a little bit of an aberration. Clive, I'll leave it to you to start talking about pensions, inflation, and how it affects people. And yeah, so you've got the conch.
Sure. So I worked for 47 years, always in the same industry of wealth management, and I retired at the age of 65. At 65, I took my pension fund as a lump sum. That's something you are allowed to do in Switzerland. It's not true in every country that you can take your whole pension fund as a lump sum, but I chose to do so. I'm allowed to do it here in Switzerland. Other countries, you can take all of it, part of it, or none of it, depending on where you live. Now, I realized that whilst I had been an advisor to people's wealth for many, many decades, I didn't advise myself as well as I should have done, because with hindsight, I should have taken my pension, or rather retired, much earlier. I should have retired at 64 or 62 or 55 or at an earlier age. Why is that? Because at a certain point, the buying power of my pension fund was going backwards faster than I could put money into it. Now, let me explain why that is. I want you to imagine that you're a fairly young person. You have a pension fund, which is so far $100,000, euros, pounds, whatever currency you have, and you're paying in $10,000 a year. So in year one, your pension fund's 100,000, and at the end of the year, you pay in 10,000, or you pay it in gradually, and it's worth 110,000. But the buying power of that 100,000 is going backwards because of inflation. So although at the start of the year you had buying power of 100,000, inflation is eating into what you could buy with that, and it drops back. I'm going to say 5% inflation. It drops back to a buying power of 95,000. Then you put your 10,000 in, and you now have $105,000 of buying power. So your pension fund is still growing thanks to your contributions. All well and good. But when you get to a certain age, the buying power of your pension fund is going backwards faster than you can put money in. So in my case, let's assume for simplicity, it's a pension fund of 1 million and I'm paying in 10,000. If we have an inflation rate of 5%, my million of buying power by the end of the year has dropped back by 5% to 950,000, but I'm only paying in another 10,000. So I'll go up to buying power of 960,000. So despite my pension fund getting bigger, the money in the pension fund's grown, the actual number of things I can buy has gone backwards. I went from a million of buying power backwards to 960,000 of buying power after allowing for the 10,000 I put in. Now, buying power is open to the definition of each individual. In my case, what I was planning to do with the pension fund was to invest it in a very diversified portfolio, which in fact I did, and that included income generating assets. I think the way I would like to generate income is from equities, because I really don't trust cash and bonds and money market. But as everybody knows, the price of equities over decades after decades has been going upwards, 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 and the prices have been rising faster than I compared to my pension fund in the recent decade or so. So if I took a very simple example, if I would have retired at the age of 55 with a much smaller fund, I would have been able to buy, let's say, 100 shares of Apple. Now I retire at 65 with a much larger fund, but I can only buy 70 shares of Apple. because the price of Apple's gone up. And I use that as an example, but I could literally take any stock market index or any major stock in the world, and they've all gone up. So I think my point to people is, if you're thinking of retiring, you need to think about when you do it and what you're going to do with the money. Now, if you're the sort of person who's just going to draw a regular pension fund in an annuities type, because you don't understand stock markets, you don't understand gold, you don't understand other types of investments or property investments, then probably you're better off working as long as you possibly can and taking the annuity and living off that. But if you know what you're doing, and you've been watching Mario's programs, and you know how to invest your money and the opportunities available to you, and you're smart enough, and you feel you're smart enough to do it, at some point your pension fund is going to be going backwards due to inflation, because you're not putting in to your pension fund as much as the depreciation of your buying power. So you probably want to be thinking about retiring a little bit earlier, taking your lump sum if you can, and investing it in those kind of things you plan to invest. And that, depending on the individual, could be could be anything, but I don't obviously recommend bonds and cash, but properties, works of art, gold, silver, Bitcoin, equities, I think, is a favorite of mine, because you have every company in the world, the boards of directors are smart people. They're working to make money for their shareholders. I think they'll see their way through the thick and thins of this world. Of course, we'll have very large ups and downs, and I know a lot of people think that equities are a little bit overpriced and could be in for a big decline if this geopolitical situation gets worse. I don't know that. All I can say is, throughout my career, we've had geopolitical situations every year. You only have to go to Wikipedia, pump in any year you like, and you'll find terrorism after terrorism, followed by war after war, and that's literally every year. So equities seem to cope with all the turmoils of the world, but they do have their ups and downs. A good example was at the in March 2021, where we had the COVID start. Equities literally crashed. I can't remember how much they went down, but it must have been 20 or 30% within a very, very short space of time. And if you can't handle that, you shouldn't be doing it.
Yeah. So do you think the pension fund managers, they don't do a good enough job to make sure that your pension grows? Because you'd think they they try to do the same as you would, privately, after you've cashed in your pension. And yeah, so
do they do a good job?
Are they just concerned with performing better than the other pension fund managers? So they have this thing that if they're only down 2%, but the whole pension fund industry is down 4%, they've done well. Is that why you think they fail pensioners?
First of all, pension fund managers are like sheep. They want to do the same thing as everybody else, so they stay within the pack. There's no point in being an outlier, because if you get it wrong, you'll be seen as a fool and you'll be fired. So you'll find the vast majority of pension fund managers do not take bets which are outside what the majority are doing. The second thing to note about pensions is, depending on the country you live in, the government may have mandated how much you must hold in what's perceived, or was historically perceived, as safe investments, i.e. government bonds. So you might find your pension fund manager is forced to hold a certain percentage in government bonds. That is the case here in Switzerland, and I'm quite sure it must be the case in many other countries. But even if it's not the case, if your pension fund manager is managing your assets along with everybody else's assets in a big pool, he's not going to be taking too many risks, because he has to manage those assets in a way where they'll have the cash flow to deliver the pensions required at the relevant dates, which sometimes are many, many years in the future. But he doesn't want big swings in the value of the pension fund. So even if he thinks that equities are a good idea, and many pension fund managers do think that, they know it, and we talk about it, they say, I wish I could invest more in equities, or other things, or gold, or whatever. Many pension fund managers feel that they dare not do so, because if the swing in the other assets goes the wrong way, they can end up losing a lot of money, and along with it, their job. So even though that in some countries there is no rule about how much you can invest or have to invest in government bonds, in most cases the pension fund managers will invest in a fairly cautious and stable way. The bad news of that is that a decent percentage of your money in your pension fund will be invested in government bonds, corporate bonds, and money market funds, and so on. Up until now, that's been a fairly safe way of investing, albeit that the interest rates were very low, and now they're starting to get higher interest rates, which it's a twin-edged sword, really. On the one hand, they've lost a lot of money on the bonds because if the interest rate rises, the bond prices fall, but when they reinvest money, they can buy a higher interest rate. But the real danger we've got with investing in bonds and fiat-like assets is the over-indebtedness of governments. We've reached we've probably passed the point of no return. The expansion of government debt is growing faster and faster. Interest is piling on interest, and interest rates are going up a lot around the world. And that's eating into the government's revenue, meaning they've got to borrow money to pay interest on the debt. Now, we all know that if this was a private individual, sooner or later, the interest on his credit card debt would be exceeding his salary and he goes bankrupt, or he finds that the credit card companies won't lend him anymore. Now, that's not actually the case as such with a government, but it does become over time more and more difficult to borrow money, which pushes the interest rates on that the government has to pay higher and higher until eventually something breaks. And I can't that because we don't know the answer, but we're getting close to something breaking now.
Yeah, and Clive, I just wanted to also tell the viewers that we're not like giving you financial advice. We're just giving you an idea of what you can do, and it's up to you to do your homework and decide whether you should do what Clive is talking about. And Clive, you're talking about bonds, and I just looked up this morning because you were saying that a lot of pension fund managers are forced to put monies in stocks and bonds. There's the 60% equities, 40% bonds, and last year was the worst year, I think, in decades for that strategy. And checking here, the TLT, which is an ETF that mirrors like long-term treasuries, it's down another 17% almost year to date. I know that equities have performed well this year. You look at the NASDAQ, it's up 20%. But I think a lot of that is just a few big companies. The Dow actually is down 2% year to date, and the S&P is up 7.25%. And looking at gold now, gold is up about 10% now in dollars year to date, and it has been up about 9 to 9.5% every year since the year 2000. And someone showed me a chart comparing the NASDAQ to gold. And in this century, actually, gold has outperformed. So maybe you could talk a little bit about that and how you think this 60-40 is going to go forward. And do you think regulators are going to have to change their minds? Or do you think they're going to keep piling pensioners' money into the crashing bond market?
Well, the reason gold continues to rise is because the value of money is going down. I actually obtained my first gold coin from my grandfather. He gave it to me when I was possibly about 14 years old. It was a gold sovereign. It was probably worth £3 or £4 at the time. By the time I started work at 18 years old, it was probably worth about £15. And today, I think you probably have to fork out £300-400 to buy one of those. So that in terms of preserving its buying power has been a very good investment. It'll probably buy me as much beer or bread or chocolate as it would have done back in 1965 or so. Now, I actually bought my first ounce of gold in 1975 when I was working in the City of London, or maybe 1976 or 77. And back then you could go to a firm called Sharps Pixley, which is still around today. And they were selling Krugerrands. That was the thing to buy then. And I bought so I've still got that Krugerrand, and I've bought a few over the years since then. And as you say, Mario, whilst gold has had its ups and downs, the tendency has been for it to go up. And the reason it goes up is the value of your money is going down. The governments have been printing, especially since the year 2000, the printing presses have been speeded up. And then we had the 2008 financial crisis, and they went into overdrive to bail out all the banks. Basically, what happened then was the central banks printed a lot of money so the government could put money into the bank. So the government would borrow the money, issue treasury bonds or gilt-edged securities or euro bonds, government bonds from Europe, and that money was then pumped into the banks to save the banks, and it saved the banking system at the time. But the interesting thing was that it didn't have much of a negative impact on the economy when it happened. So the governments had learned a valuable lesson as far as they were concerned. We can print money with impunity. So the central banks were encouraged to continue printing money for every economic crisis which came along, whether it be a recession or failure of an institution. And then we went into the COVID situation, and they started printing money to pay to keep the jobs of all the employees who couldn't go to work. Very admirable thing to do. But this money the quantity of money has been increased and increased. And as they did that, they brought the interest rates down to zero, effectively, in many countries. And we are now trying to normalize, or at least the central banks are trying to normalize, and they're finding there's great difficulty in finding anyone to, well, as they raise the rate, the government is finding it's difficult to continue borrowing because they still have a very large borrowing need to finance their budget deficit. There aren't enough takers, and interest rates are rising for the bonds as well. So one of the things you and I look at a lot is the 10-year Treasury and the 10-year gilt and the 10-year JGB. That's the Japanese government bond. So I'm coming into the acronyms that people are perhaps a little bit unfamiliar. But all these bonds, including the European government bond, all of these bonds are at the highest yield we've seen in years. Put it another way, that means the lowest price we've seen in years, which means the pension funds which held them are losing money at the moment. The reason for that is the public at large has started to get indigestion to buy more government bonds from a government which is effectively going to default, or something bad will happen, or they'll inflate it away. I don't think it's a default myself, but I think it's going to be a range of possible incidents, one of which we'll talk about in a minute, which is and that is how the introduction of the central bank digital currency might make your bonds and your cash worth little or nothing.
Yeah, and the other thing that's happening is that this age of zero rates, which we had basically from 2008 until a year and a half ago or so, what that's done as well, it's destroyed the value of savings. And in a capitalist system, you need savings to invest and to grow the economy. And I think that's also been the other side of the coin, that our private economies, domestic economies, haven't been doing well, and governments can't get enough tax revenues. So that's a big trouble there too, in my opinion. And the other thing that we're seeing, Clive, that most people kept, they were saying when the Fed started raising rates and the central banks, while gold is going to collapse to $1,000 because higher rates are going to drive gold prices lower. But as we speak here, I mean, I've noticed that the pound is closed at a new all-time, well, gold is closed at a new all-time high in pounds at 1655. In euros, it's right near the all-time highs at 1900. The same thing in Aussie dollars. And even in US dollars now, we're only about $60 away from the all-time high. Could you, before we go into CBDCs, and also how your pension could be at risk from the, if we want to call the great taking, could you give your opinion why gold is doing so well, relatively well, and whether that means that people are losing confidence in the central banks? Is that what it is?
About a week ago, I wrote an article on LinkedIn pointing out that something very strange is happening to the gold price at the moment. The gold price is rising at the same time as the interest rate on the 10-year bond is rising. That's rather unusual, because as interest rates rise, the cost of carry, which is the opportunity cost of not putting your money on deposit, is rising, which tends to mean that the gold price will go down normally when interest rates rise. What's been odd this time around is that instead of being negatively correlated to the yield, which was historically the norm, gold is rising as the yields rise. So despite the fact people could be getting more and more on their money market fund or buying a 10-year bond, making the opportunity cost of holding gold much higher, people are still buying gold, and gold has pushed to an all-time record, or nearly an all-time record, in almost every country on the planet. The only one where it's not exactly at a record, I think, is the US dollar. As you said, it's maybe 1 or 2% away from the record. And people are diving into gold. And the reason they're going into gold is something has changed in their perception of the safety of government bonds. I don't know if you noticed this, Mario, but the yield on the US government 10-year bond is now exactly the same as the yield on emerging market local currency bonds. That is absolutely shocking. It's something which has never happened before. Local currency emerging market bonds historically had a much higher yield than the US dollar, because emerging currencies were dodgy currencies which were devalued all the time. The governments were quite often very unstable, and you'd normally, in normal times, expect your emerging market bonds to have a higher yield than the treasuries. Right now, treasury yields have, or rather, the yield on the emerging market of treasuries has reached a point where they're roughly the same. In other words, the treasury yields have risen when emerging market yields have not risen as much. Now, what does that mean? It means that investors are valuing the US dollar treasury bonds in the same way as they're valuing the bonds issued by tin pot countries run by dictators, which might be overthrown any day. That's how risky people are perceiving the US Treasury market. And I think the same is true of the gilt market, where the yield is pretty much the same.
Yeah, and I've got here a chart of gold in Brazilian real. And yes, it's near an all-time high, but it's actually, you would expect it to be way above the all-time high because it's a third world country currency, but it's actually holding up really well. And the Brazilian real, I think, has actually gone up versus the dollar in the last 2.5 years, mainly because the Brazilian Central Bank reacted much quicker to a rising inflation than the Fed. So yeah, I'm not surprised, and people are waking up to the fact that yeah, there will come a day when the Treasury, the UK, the European countries, you can't keep just creating this debt and printing money to buy it. Investors are going to wake up. So yeah, I agree with your point there about that. And I did see that yeah, I think there's a guy on LinkedIn that we follow, and he's actually based in Brazil. He noted that emerging market local bond yields are the same as U.S. Treasury yields. Like you said, that's something that's never happened. And I always wondered over the years, Clive, and I think the reason they got away with it is that the cycle was favorable still to lower yields and higher bond prices. But I wonder to myself, the more you borrow, usually, if as an individual, if you borrow more and more and your job is not going well, the credit card company is going to charge you more. And it's the same thing for countries. And I think that's what's happening. So maybe we could switch over now to a really important part, which is not only can inflation eat away at your pension pot, but also, with governments so desperate of keeping this debt bubble going, that they could come and like confiscate a lot of your savings. And some people think that's crazy, but as I covered in a video about a month ago, or maybe a little longer, the Great Taking, I covered that book, and you can find it. Just Google The Great Taking. And this guy's done a lot of research. David Rogers Webb, I think is his name. And it's all legal. So maybe you could go over that.
Well, I think the old adage is, if you don't hold it, it's not yours. So that's the problem with your assets in custody. There is a risk that they may be taken or confiscated, because there could be they are your assets, you're entitled to them, but the institution which has got your assets may have a lot of derivatives outstanding, and if things go wrong, everybody's going to be running to grab those assets, as happened with Lehman Brothers. It was a huge mess to unwind, and at the end of the day, with Lehman Brothers, the investors did not get back all of their money, because there were too many people saying, we hold some of those assets and we're not going to let them go because Lehman owes us money too. Now, that's, I think, the gist of the book, The Great Taking, that when you have assets in custody, you can't be sure that you're going to get them back. And there could be multiple reasons for that. But let's look at what's happening to Russian oligarchs and wealthy Russians around the world, who suddenly, some of them maybe are closely tied to Putin, and some of them got nothing to do with him. Suddenly they found their yachts were seized, their properties were sequestered, their bank accounts were frozen. And I have a friend who lives fairly near to me. He's a Russian by origin. No, beg your pardon, his wife is a Russian, he's a Swede, and suddenly they found their bank accounts were frozen. Now, I guess they've sorted it out by now, but we're talking about back in February last year, when Russia invaded Ukraine. So, but there can be many circumstances why you find that the assets you've got in custody, you can't get them back. So that's why it always makes sense to have a little bit of gold in your hands, or your safety deposit box, which you can lay your hands on, so that you have something outside of the system. Shall we talk? So the other thing we want to talk about, Mario, was the coming of the central bank digital currency. And I've been talking to a lot of people, and I think that a lot of people have never even heard the word central bank digital currency, and they don't know what it is, and they think it's just the same as what we've got already if they hear about it. So I'd just like to go into a few lines on that, and then explain why it's going to be bad for pension funds and for money market funds and deposits. The central bank digital currency is a form of currency which will be issued by all the major central banks around the world. I think there's about 150 countries working on it at the moment, and they are all going hell for leather. That means as fast as possible to get this into the system and circulating. The central bank digital currency, let's say you're in UK and your money is British pounds, the law in the UK. The central bank digital currency will be British pounds, but they are a slightly different type of pounds from the pounds in your bank. The pounds in your bank are a liability to your bank. Your bank has promised to repay them. The central bank digital currency, the closest that I could get to it are the pound notes, or you don't have pound notes anymore, the £5 notes in your pocket. They are a liability of the central bank. Now, that is a fundamental difference between the money you have in your central bank digital wallet, which will be on your phone, and the money on your phone, which is in your bank, which is the liability of the bank. When the government runs into some kind of crisis and they're having difficulty funding themselves, through the national debt. I believe that one of the possibilities they have at their disposal will be to limit how much money you can take out of your bank and put in your central bank digital wallet. Now, why is that a problem? Because by the time we get there, almost certainly we will move to a situation where the only money you can actually spend is what's in your central bank digital wallet. So the money in your bank will be held by your bank, and when you want to spend it, you have to move it to your central bank digital wallet for surveillance reasons. Don't forget, this is all going to be, they're going to be able to see every transaction, and they're going to want to see every transaction for tax and money laundering purposes. So the way it'll work, you'll move the money from your bank to your central bank digital wallet, you'll invest it, or you'll buy things, and that will work fine because the money in your bank and the money in your wallet looks like the same thing. It's one-to-one until it's not. Now we're in the middle of a crisis, maybe an engineered crisis. The interest rates on government bonds are going up. The government can't borrow enough money to finance its needs. And suddenly there's a big crisis. People are rushing down to the shops. They're buying everything they can. The shop shelves are empty. There's rioting, maybe. Who knows what the crisis could be? It could be a war. It could be a pandemic. It could be something else. So they say, we can't allow this to continue. So we're going to restrict how much money you can have in your central bank digital wallet, and we're going to restrict what you can spend it on. So it's a form of rationing, as we've had many, many times throughout history, albeit not via your wallet. In the past, it was through ration. You got ration coupons, and you couldn't spend your money unless you had a ration coupon to go with it. In the new world, you won't be able to spend your money unless your central bank digital wallet says you can. So in a crisis situation, you might suddenly find that you're limited either as to what you can spend your CBDCs on, or how much of your old money you can put into your CBDCs. Now, I'm going to take the latter example and say that they bottleneck it and say you're only allowed 10 or 20,000 into your CBDC. That is the first step towards making the old currency effectively worthless, because the government can then start to run the economy entirely on the new CBDC. Your salary is going into your CBDC wallet, you're buying everything with a CBDC wallet, and all your old dollars, all your old pounds are left behind in the banks. And over time, you start to realize you can't use those dollars or pounds to buy anything because there are restrictions on what you can put from the bank to your CBDC wallet. So those old pounds are worth a lot less than the ones you can actually spend. Now, that is one scenario. It's not the only scenario. There are other scenarios to deal with the problem, but it's a scenario which I think is looking more probable to me, as it would work very, very well, because it would effectively allow governments to leave behind all their old liabilities in what is becoming or will become a defunct currency, and effectively run the economy on the new CBDC, which looks and smells like the same thing, except you can't convert old to new. And the governments will effectively be debt-free because their old debt is denominated in a currency that nobody can spend. You can't destroy the economy by moving it around or speculating against it anymore. It'll be very good for the man in the street because his mortgage will be in the old currency. His credit card will be in the old currency, and this will be, again, very useful because it'll be in a currency which is deflating away to nothing. The corporations who've borrowed money with their bonds are issued in the lawful currency of the land at the time, and unless there's some legislation to say they're converted over, and I don't see why there should be, those bonds will be left behind in the old currency. So effectively, it'll be a kind of global debt forgiveness where the debts of this world are wiped off to the detriment of those who are wealthy and hold the mortgages, or hold the money market funds, or hold the deposits in the bank. So it's a wealth destruction event. But what follows from that will be a world of great prosperity, because the wealthy who've got their houses, their cars, their equities, their gold, they will be able to redeploy their wealth and start building, start reinvesting, and companies who've now had their debts wiped out will be able to reborrow to build more factories, employ more workers. The man in the street will have more money in his pocket because you're not paying interest on his mortgage anymore because it's effectively a defunct currency. So he will be spending more. So it could lead to a great deal of prosperity if and when it happens. But there's no government which is brave enough to say, we're going to do this. it's going to happen by force of economics. There'll be something happens with it, and I think it could well be in the currency markets, it could well be in the government debt market, because things are very, very strained at the moment with the level of government borrowing. Something goes wrong and the government says, oh my God, it's an emergency, we have to do something. And suddenly you find that if you have a lot of money market fund, you have a lot of bonds, you have a lot of deposits, you can't deploy them. And effectively, over time, you start to realize it's just like the Nixon closing the gold window. It starts to gradually go down to zero.
And do you think the public will buy the new digital currency after the crisis? Wouldn't people be asking, can we trust these people again? Or do you think something like gold will have to be part of the new system? And also a second question is, how can people prepare for this eventuality right now? And is it possible to prepare to be 100% safe from that? I guess it's that's my couple of questions there.
So the public at large, first of all, as we stand, I would say most people still have not heard the word Central Bank Digital Currency, or CBDC. And if they have, they've said, oh, it'll never happen, or so what? I use my credit card and it's just going to be the same thing. But it's not. There will be a lot of opposition to the CBDC because of the surveillance aspects. Now, in a number of countries, they are promising they will not monitor your transactions. They won't use it for nefarious purposes of spying on the citizens. But we all know that's a promise which will be little by little whittled away, as they say. Well, we need to know what you're doing just to make sure you're paying all our taxes. We need to know what you're doing just to make sure you're not money laundering. We need to make sure we know what you're doing just to make sure that you're not publishing articles on YouTube saying the government's crap, or whatever it happens to be. So little by little, those promises that you will not be monitored and surveyed will be withered away. And they will bring in some laws which will make it legally necessary to use the CBDC and not the money in your bank. So everything will have to transact via a CBDC wallet, whether it be the one on your phone or the one held by your bank on your behalf, so that it can be monitored and surveyed and taxed in the right way. Now, that means there will be a lot of public resistance as people start to realize this, but I don't think it will be enough to stop it happening. The governments of this world are hell-bent on making it happening. So it's going to come, and I think there's not a lot we can do about it. That's the way the public are going to react to it. They're going to basically say, what can we do? It's here. We've got to live with it. Well, we've got cameras everywhere. They see what we do. They can look at my credit card anyway. They can look at my bank account if they want to. So what's changed? So I think people will grudgingly accept it. Where I think it will cause some problems is more in the families, because I can imagine there's going to be countless situations where people would like to spend money without other members of their family knowing. And if you have a controlling partner, at the moment, you could go out and spend a lot of money without her knowing, or him knowing, being very woke here. You could go and spend a lot of money without them knowing by spending cash. But once it's in your CBDC wallet, it'll be, give me your password, I want to see what you spent the money on last night. So if you go out to a bar with your mates and buy a few rounds of drinks, and she says, how many beers did you have? And you spent, I had one. Well, that partner would be able to look in your wallet and see what actually happened. And you can imagine that could be a much wider range of things than having a few beers at a bar and more serious things. So I think family disputes will happen more often if people can see each other's wallets and don't like the way their partner spends the money. And how can people prepare for it? Well, that was your other question. First of all, there are dangers if you hold cash, bonds, money market funds, deposits, because if, as I describe it, and it is one scenario, there are others, but all of the scenarios are bad for the holders of fiat money. But if, as I describe it, the currency effectively is replaced through the back door into the new CBDC, and you can't actually move your old currency into the CBDC after a certain time, that means your old money is effectively becoming worthless. And therefore, my first suggestion for people who think that I could be right is to not have all your money in cash, bonds, and money market funds. Now, just to be clear, I do have cash and I do have a little bit of bonds. I don't think they're a very good investment, but it's necessary to hold enough to see you through necessities of life, such as paying unexpected medical bills. You've got your taxes to pay. You might lose your job. All sorts of things could happen. So people should keep cash. I'm not telling people to get out of their cash. I'm rather saying, look at what your needs are and then consider what you do with a surplus that you don't need. And keep it in bonds, keep it in cash is probably not the best idea for the long run. Short run, I don't see any great worries about it. But short run can turn into long run very quickly. So I would be thinking about getting rid of it. And now, in terms of what you could do outside of cash, there's a lot of things that I've been thinking about myself. For example, buying the things you might need next year, buy them earlier. So if you're thinking of buying yourself an exercise bike, well, why delay? Buy it now. Don't wait till next year. If you're thinking of buying a garden shed, buy it now. If you're thinking of having a loft extension, a loft conversion, or a house extension, good time to do it. That new furniture you wanted, why wait? All those razor blades that you use every year, you must use tens or hundreds every few years. Well, you could buy 5 years supply now. They'll keep. You could even buy tin food. It's not my idea of prepping, but you might want to do that. But of course, then the other side is storing wealth. And Mario, you're the man who knows how to do that. And I think there's two things. One, for large quantities of wealth, you could buy gold coins, 1 ounce gold coins, they're $2,000, nearly £1,700, I think. Or for smaller amounts, you could buy silver coins. And the difference between the gold and the silver is gold is much more of a store of value, store of wealth, than silver, which is effectively usable in a crisis situation of currency. Because if the system starts to fail, the banks close, and they will close when they do this eventually, temporarily anyway, you're going to need something to help you, your friends out. And I can tell you the average man in the street is going to very quickly learn what a silver coin looks like and how much it's worth, as will the shopkeepers. Your local farmer will, without the slightest doubt, in a crisis situation, have figured out that a silver coin is worth a loaf of bread. What's that one, Maria?
That's a Morgan dollar. So that's about 0.72 of a troy ounce. And that's a 1964 quarter, which is a quarter, of a dollar. So there you go.
And they maintain their buying power today. They'll buy just as much as they did 50 years ago.
Yeah, and I've got UK ones as well, pre-1920, the pre-1947. From 1920 to 1947, the UK coins have 50% silver. Prior to 1920, they have 925 silver. Clive, just one question, and this is not because I'm involved in nefarious activities, but some people would argue what would happen to gambling, a lot of vice-related activities that are usually done in cash, and a lot of big criminals and even politicians could be involved. What would happen to that kind of activity under a CBDC world? Or are they going to use, how are they going to cope?
Well, as the fortune teller used to say, cross my palm with silver.
I see.
So, you put the silver coins on the fortune teller's palm, and then she'll tell you your fortune. Now, I'm not suggesting that's the way people will engage in nefarious activities, but there are a number of nefarious activities, if we use that word, which will never ever go away. They've been here since the beginning of time, and they'll always be here. And the government's really got two choices. You could, as they did with the prohibition in America, where it was illegal for many years to consume alcohol, they can try and control it by banning it, or they can tax it. Well, what the government quickly realized when they banned alcohol was that lots of mafia gangs sprang up all around the place, and they had what was called the speakeasies. These were the illegal bars where people could go and drink, because people have been drinking since the beginning of time, and they always will. So the government quickly realized it would be a lot better to tax it than ban it. And the same thing applies to all the other types of things we might want to do, like gambling and so forth. So I think those activities will still be there if the government's got its brain in gear and finds a way of taxing it. But of course, you can imagine that today there are some kinds of activities which are rather hard to tax, such as meeting a lady of the night. She probably isn't paying her taxes, but when we get to the CBDC, unless you cross her palm with silver, she's going to have to pay her taxes, because they'll know.
Yeah, very interesting. I'm sure people will find a way. And yeah, I was just wondering because a lot of politicians are involved in these nefarious activities, I think. So yeah, I'm sure they'll find a way. Another reason to have gold and silver, not because we're urging people to do those kinds of activities, but just because there will be more demand for it. So, Clive, I won't take up any more of your Saturday morning. So just wanted to ask you if you have any final words for the viewers before we wrap up.
About twice a week, I write interesting articles on LinkedIn on various financial matters, which might be of interest to anyone who's got money invested in any way. They're on a whole wide range of topics. So what I'd encourage people to do is go onto LinkedIn and follow me. I don't make any money from any services. I give a lot of advice to people who want advice. I do it for free. And when I say advice, it's very generic. I'm not telling people what shares to buy. It's more, for example, I had somebody the other day who was concerned about an inheritance problem, a quite complicated inheritance problem. And we talked it through and found a solution. And by the way, the solution did involve the use of some gold.
I see. And yes, if people want to connect with Clive, it's Clive Thompson, and he's on LinkedIn. Clive, thanks again for coming on the channel, and have a great weekend.
Thank you very much, Mario, and I'm looking forward to speaking with you again. And thank you to all the your viewers who are clicking the like button.
You're welcome. Take care.
Bye bye now.
Bye.